Hello, everyone. It is Tuesday, November 1st. Happy November. We're getting into the holiday season. We wanted to take some time and give you our market and economic update for November. We're going to take a look at some charts, look at some interest rates and some bonds. Always take a look at the stocks, what we're seeing underneath the surface. We're starting to see a lot of improvement underneath the surface in individual stocks. And we'll share some details on that, as well as some context around the election coming up and how the market may or historically reacted. So let's get going. This first chart is of the 10-year Treasury yield. So we've been speaking a lot about this. Interest rates have been the story so far this year. I shared this last month, just kind of a continuation. You can see we're getting that rolling over of Treasury yields having reached, into the 4.4 range. Now we're back around that 4 range. We even clicked below 4 for a few days. So we're getting that rolling over of interest rates on the 10-year, which should ease pressure on bonds and long duration stock assets like growth and technology. On the bottom of this chart, you can see we're starting to see a decline in relative strength, which is a momentum indicator. So we're seeing that falling in the momentum. We're seeing the rolling over in the price itself. This is a good sign that we possibly have put in a peak for interest rates for this cycle. We got a lot more on that coming up. What we did want to show is there's also a longer term trend in play here, represented by that green line. We have fallen below that as well. So another indicator that it's possible, right? Nothing is for sure in this world. It is possible that interest rates are going to start coming back down, which will be a good sign for the overall market. Now, after those interest rates have gone down, it's early, very early, but you can see we're starting to see a tick up in bonds. This is the 20-year Treasury bonds, just an aggregate of all the bonds, 20-year plus Treasury bonds. So seeing some early signs very early in this, but this is what we expect. We've shared that many times. Interest rates go up, bonds come down, right? Interest rates come down, bonds go up. We're seeing some early signs of that happening. I've been talking about how that the market doesn't wait, for actions to actually happen. The market prices in what they believe is going to happen long before it does. With these interest rates that are going to be coming in the next, 2 days, right? They're going to release interest rate rises tomorrow, and then also an expectation of a 50 basis point hike in December. That is already priced into the market. Okay, the market has already said and already made the trades they want to make based on that information. Okay, what we wanted to show that in context is that the 10-year Treasury yield will typically peak before the Federal Reserve stops raising or pauses. Okay, there's a big chart. I'm going to zoom in a second. But the blue line, okay, that's the 10-year Treasury yield. And the black line is the federal funds rate. Okay, and you can see there is a peak, okay, of the 10-year Treasury yield before the federal funds either stops raising or at least pauses. Okay, zooming in, here's 3 instances. You can see we have a peak in the 10-year before interest rates start to come down. Okay, the market is going to price everything in long before it actually happens. Okay, if you're waiting for the federal funds or the Federal Reserve to cut interest rates before you go buy bonds or what have you, there's a good chance you're going to miss a little bit of the swing up, because that 10-year is an indicator of what the market thinks the Fed is going to do over the next 3 and 6 months. Okay, we are potentially seeing that right now. We've gotten that peak, as I showed you earlier, on the 10-year. Now we're starting to see some conversations from Fed officials that, hey, we're going to raise in November, which is going to be tomorrow. We're looking at a raise in December, but there's a really good indication that we're probably going to have to pause and take a look around and see where the market is. Okay, that's why we've kind of rallied here these last couple of weeks. It's because the market is getting hopeful that, we have inflation under control, or at least, tampered, and that we will be able to pause interest rates and quit putting so much pressure on basically all assets, especially bonds, and have them float back up a little bit. So that is hopefully coming down the pipe. Let's switch over to stocks. Okay, again, let's take a long-term view. We are still very much in a bear market, as you can see by that declining red line. Okay, this is every one of these little white and black ticks here represents 1 week's worth of trading. Okay, so we've got the COVID crash in there on the left-hand side, and now we've got the drawdown of 2022 on the right-hand side. Now you can see that faint green line, that's the 200-week moving average, all right? So the average price paid for every share over the last, or at the close, the average price at the close of the week over the last 200 weeks. And you can see the market came down and hit that line 3 weeks ago and bounced back up. That's a very good sign that these long-term trends are going to hold. Okay, you can see back there in 2018 on the very left-hand side of this chart, did a very similar thing. Came down, touched that 200-week, and then rallied higher, okay? Looking at a more short-term view, on the bottom, you can see that relative strength again. Okay, again, this is a momentum indicator. We're starting to see some divergence here, right? Stock is still coming down, but the momentum is starting to build, okay? Hopefully that can take hold and we can continue to see relative strength tick up as well as the market. I want to show an example of a few times this has happened in the past. Okay, here are 3 times where we have gotten, well, 2 that have came to fruition, right? Where we have seen relative strength on a weekly basis start to build, okay, while the stock market is still coming down. These are divergence moments, okay? So stock market coming down, relative strength building. You can see these have historically been some pretty good times to be buying, okay? This happened in 2015 going into 2016, as well as the 07-08 crash as well. So anyway, we're seeing that again here today, right? The relative strength on a weekly starting to build. Hopefully the market will follow suit. Midterms coming up next week, right? Lots of talk around here, lots of talk in the financial world about seasonality. So I want to speak about that a little bit. Seasonality is, hey, what typically happens, around this season of the year. So you can just look at, months or quarters, but then you can narrow it down and say, okay, what about fourth quarters during midterm election years? And historically, that's been a pretty good time to invest. This is the average market action during a midterm election year. So you can see the average is pretty bland through October, right? Market just really doesn't do a whole lot, but then clearly the average really starts to rally mid-October through the end of the year. Now, we've been going up the last couple of weeks, so maybe that's happening again, maybe not. We'll find out, obviously in a couple months. But the biggest thing is, I don't think the market, obviously everyone has their opinion on who they want or think should win. But more than anything, the market just wants clarity, right? They just want to know who it's going to be, and then they can go out and make whatever portfolio decisions they need to. So really, it's less about this person's good and this person's bad, or this color's good, this color's bad. It's more the market and investors just want to know who it's going to be so they can place their bets where they want to place them and get on with it. So hopefully that will be the case again this year. Digging a little further into midterm elections, you saw this stat as well. There have been 20 midterm elections since 1942. Okay, the average S&P return 1 year later from election day is positive 14.9% on average. Okay. Now, only 3 of those 20 periods saw negative returns for an 85% win rate. Okay. Again, once the market starts to gather some clarity, then typically we see people be pretty confident heading into the market. So 85% win rate 1 year later, almost 15% average annual return. This is a reason why we want to continue to hold our investments, possibly even be buying more. Let's look under the surface a little bit. Okay, so the indexes, right? The S&P 500, the NASDAQ, the Dow, right? Still battling, still falling. The trend line still negative. What's happening underneath the surface? Okay, a lot going on this chart. We're going to look at the far right. I need to show you the whole thing just for compliance, and so everything's documented. But I want to zoom in on the far right portion of this chart. Okay, so at the very top in the red, we have number of stocks hitting 52-week lows. Okay, so the market's falling, stocks hit 52-week lows, right? You can see, late September here, there was a huge spike, even back there in June, a huge spike of stocks hitting 52-week lows, 6-month lows, 3-month lows, and the like. Now, fast forward a little bit, okay, we're seeing a decrease in the number of stocks hitting these lows, okay? This is what we call the bottoming process. Before you can go back up, the market has to bottom, probably move sideways a little bit, get the batteries charged up, and start heading higher. So this is an early indication that the number of stocks hitting new lows is decreasing, could be forward looking of where we might be headed next. A little bit more under the surface. Again, a lot going on. Need to show you the whole chart, but I'm going to zoom in, okay? This is Q3 2022 earnings from companies, right? We are in earnings seasons. The bulk of it's kind of over. I think a little over 50% of companies have reported. Let's look at those two orange boxes there. S&P 500, 52% of companies reported. 67% are beating on top line, right? Or revenue and sales. Top line of the balance sheet, the income statement. 52% of companies reporting, 67% are beating expectations, right? The market thinks they're going to do this, right? They're doing this, okay? Under the surface, good earnings are being reported. Good sales, I should say. This was sales. Let's look at the actual bottom line, earnings, net income. How much money are these companies making? Again, we'll zoom in. 52% reported, 72% of companies are beating expectations on earnings. This is another good sign that under the surface, stocks potentially are doing better than what the overall market is indicating. Very important to be monitoring this. This was a fun one. I really had never seen anything like this. This was sent to one of our research reports. So this is showing when stocks in the green bar, when the S&P 500 is up for that day, how many of the underlying stocks are up, okay? And when S&P 500 is down, what percentage of the underlying stocks of those 500, what percentage are down? So in October, on the days when the stock market was up, 92% of companies were up. Okay, 92% of those 500 companies were positive if the market was positive. On the flip side, okay, if the market was negative, only 69% of companies were negative, okay? You can see looking back several years, but more importantly, just look at 2022, it's pretty much in line, right? If the amount of stocks that were going up on up days was pretty much the same amount of stocks going down on down days, okay? We're starting to see some divergence in that as well. When the market is down, it's just not down as bad. And that's, again, how you start to form a bottoming, okay, and start to build some momentum to move higher. This one is very telling, very interesting. I love this chart. It's kind of hard to see, but I need to show the whole thing, okay? So basically insiders, corporate insiders can buy and sell their stock. Now it has to be announced. They have to document it, right? It has to be well known to the public on what they're doing. Okay, they cannot trade on insider information. All public information has to be available, and then they can purchase or sell. Okay, now there's all sorts of companies who run analytics on this, and this was one of them. So this is a ratio of number of corporate insiders buying versus selling. Okay, so if you have corporate insiders, CEOs, CFOs, board members, you name it, buying stock, okay, that's an indication that they feel confident in their company. Okay, they can also sell, which may be an indication they're not so confident in their company or the overall market. Now, this is showing you on every red dot, every time the buy to sell ratio reached this level, and the level they wanted it to reach was 0.14. Okay, that's somewhat irrelevant, but you can see anytime this has reached that mark, they put a red dot out there. There's been some really good time to be purchasing, okay? The insiders don't always get their timing exactly right, but they're pretty darn right most of the time. Okay. You can see at the COVID bottom, we got a red dot and it actually spiked. See how high it got there right around COVID? Insiders knew what was going to happen here, whether their companies were going to go bankrupt or not. Stock prices were tanking. So they went in and bought shares of their own company. Okay. We're getting those readings today, right? Corporate insiders are getting in there and buying shares of their companies. Okay. It may be an indication we should follow suit, right? They've got more information than any of us. Now, more importantly is let's take a look at the win rate. Now, in kind of the middle section there, if we look at that green bar running horizontal on a 1 year later from getting this reading, the market, their stocks have a win rate of 100%. Okay. S&P 500 from one of these readings, 100% of the time, 1 year later, the market is higher. Okay. On that very first line, the average return of these instances 1 year later is over 32%. Okay. So going back, how many years did they go back? 2000. So since 2000, okay, anytime they get this reading, 100% positive market 1 year later with a almost 32% average rate of return. That should be telling, again, coupled with the rest of the data I showed you, we're confident to be holding here, to be patient and wait for the market to start climbing higher. Here's another fantastic one that I love. The market is made up of stocks bought and sold by human beings, and human beings are emotional. They are fearful. They are irrational at times, right? This is just the nature of who we are. So this is more of a study of sentiment. Okay. So are we bullish or are we bearish, right? And I don't know if you can see in the middle of the chart, if you can see my cursor there, there's these 6 different ratios and metrics that they follow. They combine all 6 to put them into a composite of sentiment. Okay, bullish to bearish is basically what we're looking at here. The percentage of people bullish versus bearish. Now you can see whenever this composite score reaches that 5.75 line, right, or right around that, you can see it's happened 3 times in the past. At the bottom of COVID in 2020, at the end of 2011, and at the bottom in 2009. Okay, so anytime investors get peak bearish like this, where they say, no mas, get me out, I don't want to be in the market anymore, you can see historically that's been a pretty good time to stay invested and buy more. And wouldn't you know it, we're getting that reading today. Okay, the amount of investors who are betting that the market goes down or wants to get out of the market is historically high, in line with these other 3 instances. Okay, this is not a moment based on the data and analytics all over the place that we need to be bailing and running for the hills. Okay, we're cautious, we're monitoring, we're ready to change. We have an open mind. Okay, we're ready to change, our thoughts and opinions if the data presents itself. But right now, we're confident that we should be holding plus buying on good opportunities. Okay. The last thing I'll end you with, so Walter Deemer is a long-term, macro analyst, probably did some stuff in hedge funds. He is a retired guy, literally lives in a retirement community in Florida now. He sent this tweet the other day and he said, current conventional wisdom appears to be that bear markets are immediately followed by bull markets, but they can also be followed by a sideways trading range, a base building process. Given current Fed policy, suspect that could well turn out to be the case here. That's kind of the camp that we're in, right? We're not saying the market is completely bottomed. We're confident that we are around the bottom. We're not saying rates have completely peaked, right? We're saying that we're very close, right? This is going to be a process. Historically, right, the last few big bear markets and recessions we've got, the Federal Reserve and the government has came to our rescue, pumped in money, bailed out companies, cut interest rates, you name it. Can't do that anymore. They made that mistake. They did it too big. Now we're fighting that inflation game today. So this is one of those times where we're really confident that we're starting to form a base, a bottoming process. It's going to take time. We have to stay disciplined, have to continue to look long term, but we're optimistic that in due time, this will all be behind us and the market's preparing for its next charge up. So as always, give us a call if you have any questions, and we look forward to talking to you very soon.